On the Spot with Michelle Makori is brought to you by Swan Bitcoin.
The US bond market is signaling distress and geopolitical tensions are flaring. The 10-year Treasury yield is up to 4.9% for the first time since 2007. Yields move opposite to price, so this signals less demand for US Treasuries. And with US debt hitting over $33 trillion, the interest expense on federal debt now exceeds America's annual national defense spending of $816 billion. And it comes at a time when defense may need to be bolstered, with the Middle East almost at the boiling point. US President Joe Biden visited Israel and pledged to support Israel and do everything possible to secure the release of over 200 people held hostage by Hamas terrorists in Gaza, including US citizens. Biden also said that he will ask Congress for an unprecedented amount of support for Israel following the October 7th surprise attack, in which over 1,400 people were killed, mostly civilians, the deadliest single day of killing of Jews since the Holocaust. President Biden also announced $100 million in humanitarian assistance to the Palestinians. There have been over 3,000 Palestinian casualties in Gaza, according to the Hamas-run Gaza Health Ministry, including hundreds killed in a blast at a hospital, which Israel and the US say evidence confirms was due to a rocket misfire launched by the Palestinian Islamic Jihad group. Over 1 million Palestinians are also in dire need of humanitarian aid, as they've been evacuating northern Gaza ahead of the Israeli retaliation. Now, Iran, which backs terrorist groups Hamas and Hezbollah, has called for the annihilation of Israel and has threatened to intervene in the conflict if Israel launches the ground operation in the Gaza Strip. And Iran's foreign minister has also called for an oil boycott by Muslim countries against Israel, sending oil above $88 per barrel. Meanwhile, the US Defense Department has deployed 2 aircraft carriers to the Mediterranean, and about 2,000 more US troops have been ordered to be ready and prepared to deploy to the Middle East. And meanwhile, on the other side of the globe, Russia's President Vladimir Putin was given the red carpet treatment during a meeting with President Xi in Beijing. Putin referred to the growing number of conflicts in the world, saying all these outside factors are common threats that strengthen Russian-Chinese cooperation. All right, well, here to discuss all of these developments and their impact on the economy, the dollar, the markets, Bitcoin, and gold is Larry Lepard. Larry is the managing partner and founder of Equity Management Associates and a partner at the Bitcoin Opportunity Fund. Larry, thanks for joining us.
Oh, great to be with you, Michelle. Thanks for having me on the show. Your lead-in leads me to, pose the question. Other than that, how was the play, Mrs. Link? It's really a tragic set of circumstances that's taking place in the world right now, and nobody can be happy about any of it, including me.
Right.
Having said that, your job, my job, your job is to report on it. My job is to try and invest in these conditions and protect capital. And pre your lead in, capital's at great risk, in my opinion. There are a lot of things going wrong, but everything you described in your lead in only makes the case that I will make stronger for sound money. So. And
that's only a brief summary. We haven't included all of the details of the geopolitical events. But trying to paint a picture for our viewers of where we are. This is a perfect storm of events.
It really is.
Yes, Larry, we want to focus on the markets, the economy, oil, of course, as it impacts inflation and all of this, gold, and Bitcoin. But before we really get into the geopolitical developments and tensions, which are very fast developing, let's start off with something that you have been following for a while now and that you have been warning about for a while now, and that is the distress that we're seeing in the bond market. And you say we are in a fiscal doom loop.
Exactly.
Now, the 10-year Treasury yield up today by nearly 7 basis points, over 4.9% for the first time since 2007. Explain what that means and what that signals.
Yeah. So what's going on? I mean, we're in a bursting. The bigger picture is we're in a bursting sovereign debt bubble, and the sovereign debt that's most at risk is also the reserve currency debt, which is the United States Treasury market. And what the market, I think, is coming to see, I've seen this, and many of us, including yourself, I think, have been talking about this for a couple of years. we're now getting to the stage where it's very acute and very obvious to everybody, is that the U.S. spending situation is just out of control. The U.S. government, income statement is a mess. Here we are. We have full employment. We theoretically have a healthy economy. That's debatable, and even the full employment's debatable because all the numbers are cooked. But arguably, we have a healthy economy with full employment, and yet we're running an 8% deficit. That's unprecedented. That was the kind of deficit we ran during the GFC. 8% of GDP is what I'm referring to. And the deficit this year, just ended September, will be $2 trillion, or 1.7 if you take out the forgiveness of student debt. I mean, there's some mixing up of the numbers. But bottom line, it's a very big deficit for a healthy economy. And if, as I contend, the economy is about to roll over, it can only get larger. And what that deficit leads to is an increase in debt. And when you combine that with actions taken by the Federal Reserve, as I say, inflation occurred and the Federal Reserve chose violence, right? We went from 25 bips on the Fed funds rate to 525 bips on the Fed funds rate. And guess what? That increases the cost of borrowing for everybody. And by the way, who's the largest the largest borrower in the world, single entity borrower in the world, is the US federal government with $33.5 trillion of debt. So, there's a chart that I like to refer to that I know we're going to put in the show notes that shows you how interest costs have gone up for the U.S. federal government. I mean, it's really almost gone vertical, parabolic. I mean, interest costs are $984 billion a year run rate and going higher. That's on an average interest cost of like 2.7 or 8%. And so as the debt rolls and goes to the new rate of 5%, it's going to get even larger. I mean, we could see interest costs going to $1.8 trillion a year, which is just it's unprecedented and it's outrageous. And so what it suggests is that, we've already got expenses up 14% year over year, federal government expenses, and that's because of supporting the war in the Ukraine and a lot of other things. And then we've got revenues. Tax revenues are down because the stock market has been kind of punk. And so as a result of those two things, we've got a good sized deficit now that will become a much larger deficit. I mean, I could see 3 or 4 trillion next year. And I think what the bond market is saying is no mas. You're coming to us and you're trying to sell us these bonds, and the amount you're selling continues to increase. And we're not comfortable that you're not going to have to print the money to cover these bonds, and therefore we're not buying them. And of course, less demand for bonds, all else equal, means higher interest rates. And of course, higher interest rates affects the federal government, means more interest expense, which means a bigger deficit. And wash, rinse, repeat. I mean, it's a doom loop, right? It's just every step you take makes it worse. I mean, the only way to make it better would be for the federal government to cut spending or trim back Social Security or Medicare, or try to spend less on these wars and other things that they spend money on. So, it appears to me there's no political will to have that happen. In fact, we've even got a civil war going on right now in Congress because the Republican side can't even figure out who they're going to have as a speaker. And, they kicked the can in October on getting some things, signed off on. And now they kicked it till November 17th. They got no speaker. So what happens when November 17th rolls around? And I think all of these things, Michelle, that what they say to the world and people watching, the United States is, wow, that place is really kind of broken. They're just, they can't trim their spending. That it's kind of out of control. Everyone thinks they can just issue debt without any consequence. And guess what? There is a consequence. They are crowding out the debt market. There's not enough money to fund these deficits, and therefore the rates continue to go higher. So it's a very, very big problem, and it's becoming acute, as you alluded to, when you've got the 10-year at 4.90. I mean, we'll put a chart of the 10-year slope in the show notes as well. I mean, it's starting to look kind of parabolic. It reminds me very much of what happened in the UK last fall, where the UK gilt market blew apart. And so, it seems to me that we are very close to the point at which the Fed is going to have to step in and stop the QT efforts, stop the fund, the interest rate rises, and perhaps arguably even go the other direction with cuts in QE. That'll probably take some time, but as we've already seen, and I could read the citations if you like, but it's not necessary. There've been probably 10 Fed speakers in the last 2 weeks who've looked at this. The Fed's obviously aware of what's going on, and they know there's a serious problem here. And so they've all come out and said, well, the market might have done it for us. We may not have to increase rates, et cetera, et cetera. And I'm going to just click on the CME FedWatch site. The CME FedWatch site is now saying there's a 2.8% chance of a rate increase in November at their November meeting, and there's a 97% chance that the Fed is not going to raise rates. So I think the argument we could make here, I would make, is that there's a high probability that the Fed is done, because they know that if they continue to raise rates, they're going to break the bond market, and they may have already broken it, but they're going to break it to a point that it's really irreparable. So I think what we're moving towards is monetary easing, and I think that's what gold smells. Now it's hard because gold also smells, war, and gold always goes up when there's instability in war. So you kind of got two things acting on gold. But if one goes and looks at the gold chart, I mean, we can see that. I mean, in a very, very short period of time. I mean, this was not but 10 days ago, gold was trading at $1,818, and now it's at $1,940. I mean, it has gone up a lot in a very short period of time, and that's a combination of the war and I think also sniffing out the underlying problem in the bond market. So I'll stop there. That kind of is that's my big picture summary.
That's a big picture summary, and we'll also get into what we're seeing Bitcoin doing.
Yeah,
staying steady in all of this, despite all of this potential geopolitical turmoil. Bitcoin has held steady at around 28,000. Some of that on rumors. Well, we had Bitcoin pop above 30,000 early in the week, but that was largely in connection to a false report suggesting that BlackRock's spot Bitcoin ETF had been approved. This has been subsequently denied by BlackRock, but still Bitcoin kind of hanging steady in the face of all of this as well.
Yeah, I'd love to know how many people in Cointelegraph got long Bitcoin and floated that false rumor, but we're setting that aside. It was at 25 or 26. Now it's at 28. Yeah, so Ann and I were speaking about this before we got on this recording. It's interesting. Bitcoin, it's not as widely distributed, and I consider it to be a safe haven asset because I think it's a distributed non-bearer secure bearer security that can't be messed with, and so I think it's safe haven. But it's still being adopted, and therefore it's relatively volatile. And this period right now reminds me kind of very much of the 2018, 2019 period where gold started moving first. I mean, look, gold is widely distributed around the world. 8 billion people, everyone knows what gold is. And when geopolitical trouble arises or inflation is imminent, gold tends to smell it first. Yeah. And I recall quite clearly in that time frame that gold started moving in the 2019 time frame, and Bitcoin didn't start moving until the 2020 time frame. Now, having said that, when Bitcoin did move, it moved with great authority, and it absolutely crushed the returns on gold. And as you know, and as you and I have discussed, I believe Bitcoin is the faster horse and a better long-term hold. But it's not for everybody because not everybody can tolerate the volatility. I mean, I have clients in their 70s, 80s, and 90s, and they don't want to have 70% drawdowns. And therefore, I manage a fund that's both gold and silver and Bitcoin. But the point is that Bitcoin, will get there and it will move, and it'll move hard. But it tends to sometimes lag gold, or at least on the last couple of cycles. That's what I have observed. As you also know, I'm sure you'll point out the ETF approval is a really big deal. I mean, notice how much it bounced just on the rumor. Mm-hmm. I mean, the ETF approval will bring a lot of money into Bitcoin. And Michael Saylor does an excellent job of making the point that it's very rare that you see an opportunity like this where there's a lot of money that's going to come buy an asset, but it can't buy it today because, in fact, I was just talking to a very, very wealthy individual earlier today. And I said, have you bought Bitcoin? He goes, no, I know I should, and I really want to, but I don't want to get a Trezor. I don't want to do cold storage. I don't trust myself to manage the keys. I don't want to put it on an exchange. I'm just waiting for the ETF. Mm-hmm. And I thought, okay, yeah. And you know what? I think there are a lot of people who fall into that bucket. So, yeah. So that's where kind of Bitcoin is.
Okay, but we're going to expand on both gold and Bitcoin, but let's bring it back to the Fed here, Larry, because one of the issues that people have not been buying treasuries is there's concern that the Fed will raise rates further and then older treasuries will then have less yield, right? They'll lose their mark-to-market value. That's part of the reason we had a bit of a banking crisis earlier this year. Yeah. So if the Fed signals very clearly that they're staying steady, what does that mean for demand for treasuries? Does that help? Does that hurt?
It'll definitely help. They'll get a bid, and as far as treasuries have run, and I in my investing, I do two things. I look at fundamental analysis and I look at technical analysis. Treasury yields are way out over their skis. They probably need to come back, and they probably will come back. And my guess is that all it's going to take is a statement by Jay Powell that, for now, for some substantial period of time, we might be done. And then every, and combined with perhaps a slowing of some more data points that suggest a slowing of the economy. And then, people will probably, I believe, go back to a safe haven bid for treasuries because, it's muscle memory. I'm not saying that's right, and I can't guarantee it. I mean, there's some possibility that this is the big one, and the yields never come back in. That literally we're watching the treasury market completely and totally fail. I think that's a possibility, but I'd put that at a 20%. I'd put the 80% probability is that they will pretty clearly signal that they're done for this rate hike cycle, and that will, knowing that there's unlikely to be another Fed funds rate bump up, that will bring a bid back into the treasury market. However, what that will do, and they need to do this, is that will weaken the dollar in a big way. Because if you think about it, I mean, there's a lot of debate about whether they've gone far enough on inflation. And of course, Powell has talked incredibly tough. He's tried to channel his inner Volcker, and that we are just not going to let inflation become embedded. But have they solved it or not? I mean, and you can see around the edges all these people saying, "Well, we've kind of solved it." And you've got Krugman, who's awful, declaring that that we've solved the inflation problem. You've got others saying, "Well, the new limit should be 3, not 2. We've got a little leeway." I mean, I think Powell would like to keep rates high, but I think he's scared of breaking something, and because I think we're very close to something really actually breaking, and therefore my gut is that they will start to move in the other direction, and that's all it'll take to bring some money back into the treasuries and to bring the treasury yield down from this 4.9 into the lower 4s or something. Now, which is not to say it won't go higher later on, as inflation heats up
Right.
again. But as markets kind of move in a zigzag fashion, and treasuries have gone up an awful lot very quickly. We'll put the chart in the show notes so people can see it. I mean, it's been pretty vertical. Right?
But again, that would just kick the can down
Oh,
the
yeah.
road a little further. This doesn't stop the impending blow up here.
Well,
right?
That's right. It doesn't really solve the problem. It helps a little bit, it doesn't solve that interest rate cost problem that they've got as a result of the shorter stuff. I mean, the 10 years in the 4.9 area, but some of I'll look at here on my trader view. I mean, the 2 years or the 1 year is at 5.5, and so is the 6 month, 5.6 almost. So, this is, and a lot of the debt is stacked up in very short maturities. So, remember right now, the 980 of interest costs they've got, 80 billion, that's with an average of 2.9. And yet the entire treasury curve is over 4, and a lot of it's over 5. So as it rolls and as the average goes up, this deficit problem is only going to get worse. And, the revenue problem, I mean, we've already got tax receipts down 7% year on year. If we do enter a recession, that's going to get bigger. I mean, every past recession, the gap in the deficit has gone up between 6 and 12%. So if we're already running an 8% deficit, and we, let's say we pick a middle of that, maybe 10-ish, we could go to a 16% deficit, 16% of GDP on a $25 trillion. I mean, we'll have a $4 trillion deficit. And of course, we've got interest costs on that, and rinse and repeat. It just keeps getting worse. So it's really a problem. I mean, the one of the things, again, we'll put this in the show notes. And one of the charts that I sent to you guys, and that I think is a really important chart to read from an excellent book, by the way, who you interviewed the author, Lynn Alden, last week. There's a chart in there that's just stunning, and it's a great chart. And what it shows is the continual growth of debt in society, and then it shows the underlying base money in society. And what you can see is that, as long as that debt continues to grow, you absolutely have to grow base money. Not necessarily in a linear fashion, because, it got way ahead of itself in 2007, and then, the GFC occurred, and then they printed like crazy, and then it calmed down for a while, and it got really ahead of itself going into COVID, and then COVID occurred, and they printed again. And, the debt continues to grow, and right now M2 is flat to slightly down, and you just know what's coming along. And so, as my good friend Greg Foss always says, monetary debasement is an absolute certainty. They have to continue to print if they want to keep the system going. Now, there are those who argue that they actually want to crash the whole system and make us all slaves and bring in CBDCs and all that sort of stuff. And I don't discount that as a possibility. I don't think it's a high probability. I don't think they're that's that evil or that smart, to play out in that direction. But it's possible. I think the more likely is they're just, they go one move at a time and they react to what the problem of the day is. And the problem of the day had been inflation,
Right.
and it's about to change. I mean, I think inflation is going to continue. We'll also put in the show notes the 2x2 or 5x5 inflation swaps are still at 2.6%. I don't think we're going back to 2.6% inflation. I just don't see it, mainly because of all the labor, cost push, and because of what's going on with oil.
Yeah.
So look, the Fed and the U.S. federal government, they are in one hell of a pickle, and I think the only way out of the pickle is inflation. And I think it's the lesser of two evils. The continue to keep rates high and try to bring it back in line the way they've been doing. I think we'll crash the economy. We'll have something that'll look like the Great Depression, in 6 months to a year. So,
and again, Larry, that is assuming that this current conflict remains confined to Israel, Gaza, that it doesn't spread beyond bringing in other actors, that it doesn't see the Straits of Hormuz being blocked, for example, oil skyrocketing, potentially involvement, kinetic war with the US potentially getting involved, Iran activating its terrorist proxies. There's so many ways that this can spiral out of control, including potentially China and Russia using this opportunity to intervene. But
absolutely. I mean, there are a lot of countries out there that aren't loving us right now. I mean, we grabbed $600 billion worth of Russian reserves.
Right. Well, and then we've got the whole de-dollarization trend as well, which we've seen accelerating. Yeah. But before we get into that scenario and how that can play out, right? Yeah. The markets are currently pricing in, the baseline view appears to be that the conflict remains confined to Israel, Gaza. I mean, that's what the markets are telling us right now, correct? Right. Okay, but let's not get into the tail risks. Let's assume the markets are right and somehow this is hopefully just contained to Israel and Gaza, as devastating as a situation that is kind of the best case in a very terrible scenario. Anyway, let's assume that happens and it does get contained and perhaps it just gets deferred and there's no real resolution to that situation and it's kind of the same status quo and it just gets kicked down further. What does that mean in terms of just the economic picture alone? And what does that mean for gold and for Bitcoin by, say, middle 2024?
Yeah, it's a great question because, I wrote my quarterly letter, which, by the way, will be out tomorrow. It'll be on my Twitter feed, so anyone can look at it and read it. It talks about all this. But, pre all the war stuff, everything I'm saying was true. The war could all make it go just, really haywire, really bad, really quickly. Let's all pray that doesn't happen, okay? Because nobody wants, death, and nobody wants all the economic chaos that might come from everything going in this direction quicker. I think, assume the war. Assume an absolute best case in the war, we're still screwed. I mean, in terms of the U.S. monetarily and economically. I mean,
just not screwed as quickly though. Still screwed, right. But not as suddenly, not as dramatically.
Right. I mean, one might have more time to adapt to it. So I think what you're kind of asking maybe is kind of what's my base case for things, how they will unfold. I think the Fed will pause sometime soon, sometime in the next 30 days or maybe 60 days. I think that will cause the bond market to catch a bid. I think that'll cause the dollar to weaken. I think that'll probably cause oil to go up and probably start to cause a resurgence in inflation. But they'll say, well, we've got to live with that because we're in wartime conditions. I mean, the one thing the war does give them is it gives them a nice cover story. We talked about this yesterday. I mean, they could theoretically start saying, well, all those of you who have 401ks and IRAs, we're going to require that you spend half of them to buy U.S. government bonds because you're getting a tax benefit, and therefore it's your patriotic duty to buy our bonds. I mean, they could do something like that. And what I think will happen is I think gold will get through 2,100. which is a very important level. It's bounced there 3 times in the last couple of years. It was at 1900 in 2011. So there's this nice big ceiling in between 1900 and 2050. And when it goes through that, I mean, in today's algo-driven world, a new all-time high, people chase it. And so I think we're going to go through 2100 and we're not going to look back. We'll be at 25, maybe even 3000, but 25 very easily, relatively quickly. And then I think that Bitcoin will follow and probably follow with gusto. And as you're probably aware, and some of your listeners, many of your listeners, I'm sure, are aware, we have a halving cycle coming up in April. So the reward of the miners is going to be cut in half. There's not going to be as much supply, assuming all else being equal. There'll be demand, and perhaps more demand, and I think Bitcoin's going to launch. And so, my target for kind of mid to tail end of next year is $2,500 to $3,000 gold and $50,000 to $100,000 Bitcoin. Potentially much higher, but I think those numbers are imminently achievable.
Now that's $100,000 Bitcoin without the war escalating.
Exactly. That's assuming a best case in the war, that things calm down and nothing gets worse. Yeah.
Well, relatively calm down.
Yeah.
But let's talk about the tail risks here, because Nouriel Roubini, Dr. Doom, who has called it correctly a few times, and who was actually on Kitco News earlier this year saying that he thought that the Middle East risk was not being priced into the markets, and that could come at the time that there would be stagflation in the US economy. So he is writing that there is a tail risk scenario. Iran is likely to unleash Hezbollah to prevent Israel from trying to destroy Hamas. Then Israel and the US have to attack Iran. That is unleashing its terrorist proxies and also accelerating its plan to build a nuclear bomb. Let's not forget about that. By some estimates, they're only several months away from that. Global stagflation follows as oil flow from the Gulf is blocked. Then China is tempted to blockade Taiwan, as the US is already bogged down in wars on two fronts, Russia, Ukraine, and the Middle East. Then he says it's looking like World War III if the US then tries to break the Taiwan blockade. And this is a scenario that others have pointed out is not implausible.
It's not at all implausible. It's not at all impossible. And it would be disastrous for the U.S. and the dollar, and for all of us, really, for our standard of living. I mean, I recall the 70s clearly. I was a teenager, and the gasoline prices tripled. And I mean, are people ready for a $15 or $20 gas? In the United States and Canada? I kind of don't think so. But that's what $200 oil would imply, I think. And it would be an unmitigated disaster. And I don't think there's any way the Fed wouldn't be called upon to, quote unquote, do the patriotic thing and print the money necessary to keep the system going. Inflation be damned, right? And then maybe they go to rationing. I mean, recall that it kind of reminds me of World War II as well. I mean, recall that in World War II, they had a lot of inflation, but they also had a lot of rationing. And my grandparents would tell me about how you got gasoline coupons, you got butter coupons, and they kind of shut everything down because there were war bond drives and all this sort of stuff. I mean, if all of that happens, they will use that as cover, the patriotic angle, to get us all to cut back on our spending and to live within our means. And it seems totally possible to me.
Look, it's a tail risk, but it's
not a low probability tail risk. I mean, I think it's a 20% shot. I mean, that's not
20% shot that this plays out like this.
It gets that bad. I mean, you just think about it. I mean, part of the reason I get there, Michelle, is I kind of look at like COVID, and I kind of look at these things, and I know you've read the book. We all kind of think about fourth turning theory, right? I mean, so the GFC happens and they calm it down. Everything's good for a while. And then, the repo blowout in 2018 happens. They pivot and they calm it down. And everything's good for a while. And then along comes, this fake virus. And, they use that as an excuse to print a ton of money. And then they calm that down and everything's theoretically good for a while. And then Powell jumps on the bandwagon and pushes up the interest rates. And, they calm all that down for a while. I mean, in theory, they got the inflation. I mean, look, inflation is unreported, but it has come down. No one can dispute that it's lower than it was. And so, And
the growth of inflation is
well,
lower
that's
than it
right. No,
was.
no,
The
obviously,
rate of
yeah, we still have
increases.
inflation. We
Yeah.
still have
We
inflation,
were still not back to
and
prices as
prices
they
have not
were.
net. No, prices have not net gone down. They're just not going up. I mean, there was a time we had rents going up 20 or 30% a year, and that's not happening, and so forth. So yeah, I mean, to me, it seems kind of natural that the next one. I mean, I think the next one is going to be big. It's probably going to be bigger than 2008, and it's probably going to be bigger than COVID. And gosh, what could happen that would be big and bigger than those two things? Well, it'd be a really major war. That would be big. That would be really big. So it doesn't strike me as impossible. Obviously, I in no way, shape, or form want to see us go in that direction. I pray that we don't, but
Mhm.
it doesn't seem impossible. And I would kind of rate it as a 20%, as against the
Yeah.
80% that we kind of keep everything pulled together.
20% is a very scarily high possibility. And
Right.
of
I mean,
course, that's the end scenario.
when you
And
say tail, I said that just because I want to point out, because when you say tail, when I think tail, I think 5%, right? That's a tail risk, or
yeah.
less than 5%. And I think it's more than that. I think it's a 20%er.
And there are also scenarios in between which will break down. But let's assume that this devastating scenario unfolds, and this will be devastating on so many fronts. Certainly a tragedy for the globe and for people. But again, this is an economics, financial discussion. What happens in that scenario? If you're looking at this and you're listening to Larry and you're going, there's a 20% chance that this can happen, what should I do? What is a potential financial protection strategy to this?
Yeah, well, look, I think we can all agree that long bonds don't make a whole lot of sense in this environment. I think that we had 40 years of deflation, which ended with peak deflation in March of 2020 when the 10-year was at 58 basis points or something. That's over. We now live in an inflationary world, and what we're discovering is it's harder to put it back in the box than we thought. So we now, we're in for 10 years of inflation that started in 2020. So we're only 3 years into the cycle. So, your easy no-brainer call is get rid of every single piece of long duration debt you've got. 30 years, 20 years, 10 years, they all suck. We talked about this off camera. There's actually an argument if you're trying to just be very conservative and don't want to swing for the fences for owning, 6 month, 1 year, maybe even 18-month, U.S. paper, because they will give you the paper back, and 5% is better than 0%. And so, owning a T-bill doesn't strike me as crazy. And maybe the T-bill, maybe say you buy 6 month paper, and in 6 months, the 6 month is at 7%. Well, fine, you roll it over, and now you get 7% on the next 6 months. So, the shorter paper can kind of make some sense, but in general, those long bonds are just a no-brainer to not be there. I also think the place where people are whistling past the grave is the equity markets. I mean, equity markets, to me, the bubble burst in December of 2021. They went down very severely in 2022. And we kind of got this echo bump coming back up. And everyone's like, AI, it's all good. We're going to have a soft landing. And I think people over there are really, really deluding themselves. I think that we are not, the odds of a soft landing are low, that, we were at peak profit margins, and labor costs are going to go up. So companies are going to be earning less. If we do have this downturn, the demand is going to be soft, so they're not going to be able to push higher prices through to consumers. I mean, I think the stock market is an accident waiting to happen and could easily go down between 30 and 50%. And I know there are very smart people who take the other side of that.
I guess perhaps with the exception of defense stocks.
Well, I'm sorry, say again?
I said except perhaps with the exception of defense stocks, maybe oil stocks, potentially.
For sure. Both those areas. I mean, look, and the reason I'm in the trades I'm in is I was a venture guy before I got into all this stuff. And in '08, I got radicalized for sound money because I couldn't believe what they did. And, I realized that if, at the age I was at with the money I had, I realized that if I didn't figure out a way to defend myself against debasement, I was going to be poor in my old age. And so I investigated what worked in the 70s, and the two top performing asset categories in the 70s were gold stocks and oil stocks. And I didn't want to do oil because it was too geopolitical, and it was too hard for me to figure out. So I went and I educated myself about gold stocks, and I started picking gold stocks. And so in an inflationary environment, you want to have sound money first. You don't want to save in dollars. You want to save in something that can't be printed. And then you want to have equities that benefit from the trend towards sound money, and that would be commodity equities. So I think if you've seen any of the charts done by Ronan Stofferly and the guys at Incrementum, we're just commodities are dirt cheap now compared to their cost to produce, and financial equities and equities in general are quite expensive, and in these long-term cycles, those things tend to reverse. So, I think that owning stuff is going to be a much better place to be in the next 10 years rather than owning things that are, financial claims like, shares of Apple, which is not to say Apple isn't a good company.
Right.
I mean, certainly better than shares of Nvidia, which is just one of the most insane things I've ever seen. So, I think everybody should have some sound money. And then to the degree that you want to speculate or invest, for growth, I think there's much more likely to be growth in, the equities that are producing things that are, related to sound money. I mean, I look at the companies in my portfolio, and I've got companies trading at 2, 3, 4 times cash flow, and that's unusual. That's very cheap.
So, Larry, in this scenario, which again is a terrible, tragic scenario, but which you say 20% chance that it could happen, I get your point for commodities, for sound assets, and you've referenced the 70s. Gold has stood the test of time much longer than that, of course, as a safe haven in times of geopolitical upheaval. Make the case for Bitcoin. Why would holding Bitcoin be a good idea in this nightmare scenario?
Happy to do it. So, as everybody knows, or most people who've listened to me know, I love them both. Okay, gold is analog sound money, proven, 5,000 years old, and it was the best form of money that existed in the world until Bitcoin came along, and it is still less volatile than Bitcoin. And for some people, that's a real advantage. They don't want to ride the up and down cycles within Bitcoin. If you look at the actual characteristics of Bitcoin as money, and it is being adopted as money, in my opinion, it beats gold on just about every front. It's easier to store, it's easier to transfer, it's easier to verify, it's more easy, it's easier to divide, etc. And so I think when the people who set up the Bitcoin network, and I do think Satoshi was a group of people who then decided to go silent. I think I've met a few of them actually, but
wow, well, that's a conversation for another time.
We talk about that. When the Bitcoin network got developed, something important was developed, and sadly, a lot of gold people think all this crypto stuff is bullshit, and you know what? They're right. All crypto stuff is bullshit except Bitcoin, because what Bitcoin did, what that system does and did, is we created legitimate, provable digital scarcity. And before that time, that had never existed. So this is an invention. It's like when the Wright brothers created an airplane, they created a device that would allow human beings to go up in the air and travel. And, from the Wright brothers to, the Concorde, was a bunch of years, but it was amazing the developments that took place. And you might ask, well, why does digital scarcity matter? Digital scarcity matters because the most important characteristic of sound money is that it's scarce. And until Bitcoin came along, gold was the element in the universe that was most scarce. The supply only grew at 1.5% a year. It was verifiable. I mean, admittedly, you had to sometimes X-ray it so that it didn't have tungsten inside it, and had problems in verifying its purity. But suffice it to say, there was no other element like gold, and that's why 6,000 years of evolution, it became kind of the preeminent form of money. Bitcoin, in my opinion, is really just digital gold with better characteristics. Now, it's not as widely distributed, it's not fully adopted, and there are two, as I say before, to add credibility to the case, there are two weaknesses or two risks, and even as big a Bitcoin advocate as Lynn will agree to these, and she writes about it in her book. There's the technical risk that in some way the network breaks or fails. I think based on who the core developers are, based on the fact that it's been working for 15 years, based on the technology involved and so on and so forth, I think that risk has gotten to be very small. It was much larger before the block wars, before the hard forks. In the early days, there were some backdoor problems, etc. But I think 15 years in, the network is pretty damn robust, and the risk of technical failure is low. Although that's why I've often said, Greg Foss says, hey, Bitcoin is a CDS on the dollar. And I'm like, that's right. But gold is a CDS on Bitcoin. So if Bitcoin fails, you want to have gold. I think the other risk to Bitcoin is that people just lose interest and it fades away. I mean, money is really what we all agree is the most liquid good, and money has always been a ledger, and Bitcoin is a ledger. And if for some reason people lost interest in it and stopped using it and didn't appreciate the qualities that it had, then okay, well, it would kind of fade away.
Well,
I think
in this scenario,
yeah,
Larry, if it does become this crisis scenario, and there's real fear gripping the markets, and there are various levels of this fear, and I'll go to an intermediate level of fear before, but in this ultimate worst case scenario, when there's tremendous fear, does Bitcoin pass the safe haven test if this develops at a relatively fast pace? Are people going to go to Bitcoin in a very, very existential crisis, potentially for the economy, potentially for people? Is Bitcoin proven enough as a safe haven for this scenario that could unfold?
It's a great question, and I think the answer is we don't know. But I think in general, I think the answer is yes. I mean, there's two other kind of knocks on it. One is that the governments are all going to outlaw it, or two, that and if we lose electricity and the internet, it doesn't work. Well, if that's the case, we're back in the Stone Age, and I don't think the world is going to that place, and I don't think governments can stop it because it's really kind of robust in terms of its ability to thwart government attempts at grabbing and controlling it. So. But has it been in people's minds? Is it a safe haven? Well, in Bitcoiners' minds, it is. I mean, I think it's one of the safest assets out there, and it's also a lot easier to move and store. I mean,
Right.
Try to take $1 billion worth of gold from point A to point B. That's not easy. You need a jet.
Yeah.
With 12 words, you can hop on an airplane and go to any place in the world, and reestablish your Bitcoin wallet, and you've got your wealth. So, by the way, a lot of people in China were doing that in the early days of Bitcoin. It was being used for that because they had capital controls and they couldn't get out. So,
and in conflict, as terrible as it is, people need something that allows them to flee quickly. And again, we hope it doesn't get to this case, but there are people that are already, having to evacuate, having to flee. You want something that you can take with you in an easy way.
It's extremely portable wealth. I mean, obviously, if you were in Germany in the 30s and you wanted to get out, having gold coins was really good because you could bribe the border guards or whatever, or use it for your travel expenses. And I still say that. I mean, I think gold coins are very useful because, there'll be people who probably won't accept Bitcoin when you got to pay bribes. But, in the end of the day, I think Bitcoin is the superior form will become the superior form of wealth. I also think, both of these assets are going to increase in value significantly as paper money, fiat money, gets debased and destroyed. But you've got, as Paul Tudor Jones says, Bitcoin's the fastest horse in the race. The reason for that is that it's got two things going on. It's got one, paper money is being destroyed. That's going to make gold go up, because it's traditional money. That's going to make Bitcoin go up. But two, it's got an adoption curve. And so we've just kind of passed the Gladwell tipping point where 10+% maybe of the developed world owns Bitcoin. And as we've all seen those adoption curves, cell phones, radios, TVs, whatever it might be, any new innovation, it kind of tends to take the amount of time it took to get to the 10% is the amount of time it takes to get to 90%. So I think in the next 15 years, Bitcoin is very likely to become the soundest reserve asset in the world. And if that's the case, and there are 8 billion people in the world, there are 21 million coins, I mean, the price per coin has got to go up a lot. One other thing I will say about Bitcoin that I think people don't understand, and this is part of the innovation that's really important. Think about Bitcoin's a commodity, right? The SEC said it's a commodity. It is a commodity. One coin's the same as the next. Okay, fine. Every commodity in the world, if you increase its price, the supply goes up. If gold went to 10,000 tomorrow, we'd mine more gold. If corn went up, if oil went to $300 a barrel, we'd drill for more oil. You would get more, higher price, you would get more. No matter where the price of Bitcoin goes, the issuance schedule is set. There's not going to be any more. It comes out, every block is, 6.25 coins right now, soon to be half of that. So, that's unique. And I, as a result of that, the world has never seen anything that really kind of looks like this, which is why, I mean, Ronnie Stofferly had a great chart on it. Showed, I mean, Bitcoin from inception has grown at 145% compound annually, and it's got a lower Sharpe ratio than any other asset out. I mean, this is an amazing beast. It really is. And so I, look, but it's volatile, and to some it's scary, and I get all of that. But I've long contended that anybody who has zero of this is really, really missing the most asymmetric bet that I've ever seen in 40 plus years of trying to make asymmetric bets.
Right.
So to me, it's absolutely an essential. You must have. How much of it you want to have, how much, et cetera. Okay, that's up for debate. I get that. People don't like the volatility. The volatility, by the way, though, it'll go down as time goes by and it gets more widely distributed.
Yeah, well, let's see how Bitcoin responds to the volatility that we're perhaps about to face on the global stage. And, we had obviously BlackRock, as we discussed earlier, applying for the spot Bitcoin ETF. Larry Fink speaking about that on Fox Business earlier this week, saying that the rally that we've seen in Bitcoin is about a flight to quality with all the issues around the Israeli war now and global terrorism. So, this is, again, a very big change of tune from the guy that said that Bitcoin was essentially an index for money laundering. But ever since applying for the spot Bitcoin ETF, Larry Fink, BlackRock, the world's largest asset manager, firmly in the Bitcoin camp, and now saying that it is a flight to quality. So I want to get your thoughts on what happens in a kind of intermediate stage. The non-20% tail risk, which, as we said, is not so much a tail risk. If this conflict escalates further, what event starts to bring fear into the market? What would that look like? Would that be, and I know you're not necessarily a geopolitical strategist.
Yeah, I'm really not. There are a lot of people who are better at that stuff than me, but
what strikes fear? Is it a U.S. involvement? Is it Iran getting involved directly or through its proxies? Is what actually happens that you start to see fear becoming the overriding sort of sentiment in the markets?
Yeah, I think if it gets hotter, which is to say, if there's more death and somebody does something that everyone regards as an atrocity, and I mean, this is how wars go, right? And then the other side has to respond with something that's even more of an atrocity. And before you know it, the gloves are off and everybody's going nuts, right? And then, Russia thinks, hey, we got these really cool, weapons, and we've got these United States, destroyer aircraft carriers sitting here. Let's try one out and see if we can't sink one, right? And all short of a nuclear exchange, but some pretty bad stuff could occur. I mean, I think we have to believe that that's all entirely possible. And there are a lot of smart people who've talked about this with the Thucydides trap, that when you get into one of these fourth turnings and the leading country is being replaced or supplanted by other countries, there's always a war. And I'd like to think that we can skip it this time, that people are smart enough to know that the outcome of that kind of behavior is just devastating for all involved. But humans are humans, and it seems possible to me that it's going to occur. So I don't completely discount it. I think in a shorter term time frame, Michelle, I think the fear you're talking about, I think that the United States is kind of living in a false narrative world of everything's okay. And it's kind of like the knight in Monty Python who gets an arm cut off. Oh, that's nothing. It's a flesh wound, right? Well, I mean, it's, to me, I mean, like, for example, recently the U.S. stock market came down and touched its 200-day moving average. I think we're going to we're going to have some bad earnings reports. We're going to take out that 200-day moving average. The bank thing that they stuffed back in the corner and into the can. I thought it was all over with Silicon Valley Bank, but of course they patched that up. But that problem is still there. There's still $600 billion of commercial real estate losses in the regional banks, and arguably half of the regional banks have no equity left. So something is going to break. One of these rivets is going to pop, and the stock market is then going to break, and then it's going to cascade, very similar to the way it did in 2008.
And what does Bitcoin do then?
Well, it's hard to say. So if it's hard to say how quickly it happens and how much we go to a correlation of one. If you look at March of 2020, I was an owner of Bitcoin, I was an owner of gold, I was an owner of silver, and silver got walloped. Oh my God, it really got hit. And then gold got walloped, and Bitcoin kind of got walloped. Arguably, I think it was about the same percentage as gold. But anyway, but it was very quick because Jerome Powell came in and said, don't worry, I'm Mario Draghi. We are going to do whatever it takes. He opened up enormous swap lines. Trillions of dollars went out the door. And then, of course, we had the enormous response with the PPP and the fiscal and, the stimulus checks, all of it, right? My sense is that if we get into a correlation of one event where what breaks is severe enough, everything's going down. I mean, literally everything is going down.
Including gold?
Including gold, absolutely. For a very brief period of time. But because the Fed knows, and because, the successors of Bernanke, who said we're never going to let deflation happen here because we have these helicopters, their standard plan. I mean, we know their mandate's threefold, right? It's employment, it's inflation, and it's keeping the financial markets working. It's being the backstop, which, by the way, they started in 1916. They backstopped the war. So, and they did what their charter 3 years earlier had said they couldn't do. So they changed the rules and they screw us. But anyway, the point is that if and when we get into that collapse, an outright collapse, and I think that's probably what will happen. There could be a correlation of one, and Bitcoin could go down quickly, and gold could go down quickly. But in turn, the response from the Fed would be overwhelming. Their balance sheet would be taken to 20 trillion. And I recall very clearly in March of 2020, when I was literally hiding under my desk, because of how badly all my shit was getting hit. And then, Powell came out, said, we're going to do all this stuff. And gold went up $100 a day, 2 days back to back. You never see that. And so that's what would happen again this time. So I think everybody has to be prepared for that. And that's why I often say to anyone who's in the investment game, that's why you don't use leverage, because you don't want to get blown out, on a very quick swing. I think there's an equal probability that we don't go to a correlation of one, that things just continue to bump along with the stock market going down, the bond market going down, Bitcoin going up, and gold going up. And then maybe ultimately something breaks, and then they have to come in and do yield curve control. And at that point in time, it's full on, okay, the economy is going to run, but we are going to have serious inflation.
Right.
Very serious inflation.
Larry, I want to bring it to a topic that you and I discussed when you were last on the show, which will most likely accelerate in light of the Middle East conflict, and that's the trend to de-dollarize, right? I mean, we have countries moving away from the US dollar, moving away from US treasuries, opting to trade in their own currencies. Yeah. The sentiment of this conflict is, correct me if I'm wrong, likely to increase that trend. And of course, we're seeing greater cooperation between China and Russia, the big members in the BRICS. And we've also seen the expansion of the BRICS, adding 6 new members, including the United Arab Emirates and Saudi Arabia. Right. So help us understand what that means in the context of, we have a conflict, but it doesn't escalate to a too terrible capacity. And again, not discounting the horror that is happening right now on the ground, but I mean in terms of spillover. Yeah, and certainly not discussing the tragedy there. But we have central banks continuing to buy gold, especially China's central bank, which is on a 10-month buying streak. You're seeing central banks selling US treasuries at the same time. We have the BRICS sentiment growing, potentially fueled by unhappiness as to what's going on in the Middle East. And we've got Russia and China cozying up more so than ever. How does that play into the de-dollarization trend and what that means for gold and Bitcoin?
Yeah. So as we all know, the dollar's been the reserve currency. It's also been the U.S. bonds have been the reserve asset. And, when we grabbed the $600 billion of Russian reserves, that really, that was in a sense an act of financial war. And obviously, everybody saw it and everybody started realizing we can't trust these guys and we can't rely on the dollar as our main currency. And I recently read that something like 50% of the exchange between Russia and China is being done in yuan. So, and I think that's only going to continue. And your point about the new people joining the BRICS, and I thought a BRICS currency might come about. Of course, it didn't. I was wrong about that. But the long and the short of it is, Michelle, is that the U.S. has had extraordinary privilege post World War II, and we've abused it now for many, many years. And the abuse is getting larger and larger, and the rest of the world is saying no mas. And so, I think what this means is that, because we could print dollars and buy oil with printed dollars, we lived above our means. And I think as the dollar continue, right now the dollar's strong because of course it's a bid to safety, and it's better than the other fiat currencies. But it really what matters to me is not the dollar versus the euro or the dollar versus the yen. What matters to me is the dollar versus gold, or the dollar versus oil, or the dollar versus things you can't print. And all the things you've alluded to suggest, and I think support the case that the dollar is a piece of shit, and that the U.S. government has mismanaged the dollar, and therefore, the cost of everything in dollar terms is going to be a lot higher. And so, I was in California recently. I know you were too, and there was $6 or $7 gas. I mean, sadly, that's going to become the low end of the spectrum. I mean, we're going to have $10 gas. We're going to have $15 gas. We're going to have $20 gas. I mean, the kind of because of the way the dollar has been abused by our federal government, and because of the way the people, as Zoltan points out, the people who have the resources. I mean, what really is kind of money in the world? What's the base layer of a functioning society? It's actually energy. I mean, without energy, we all sit in the dark and starve. And so, what is energy? Well, it's oil, and it's solar, it's natural gas, it's hydro, it's power. And so, we need, it's nuclear, which sadly not enough people understand, but we need energy to have a modern world. And those who have the energy are going to, we, the U.S., had this extraordinary privilege of being the reserve currency and being able to print and exchange it for energy. And the people who have the energy are starting to say, we're not so wild about having those dollars. We're definitely not going to hold on to those dollars. If we take them, we're going to swap right out of them. And, and when we trade with each other, we're not going to use those dollars either. So as a result, you see the dollar is going to have, in my view, just a lot less purchasing power. And that goes back to the fundamental theme of inflation. It's just another brick in the inflation wall, right? I mean,
and one can also argue, Larry, that a part of what was giving the dollar strength was the perceived status of the United States on the world stage. And many have said that since the withdrawal from Afghanistan, that projected tremendous weakness from the Biden administration.
Absolutely.
And was really an event that created a lot of faith being lost in the U.S. dollar, in the U.S. as a military power.
It didn't start there. I mean, if you were a foreigner looking at the United States, and I have a lot of foreign friends who look at us and just say, you guys are insane. I mean, what are you doing? I mean, you're being run by idiots, and I can't honestly disagree. I mean, it's really tragic how far this country has fallen from what it once was, which I consider it to be it was never perfect, but right after World War II, it was an honorable, ethical, generally ethical, world leader that tried to behave responsibly. I can't even say that because the CIA has always existed and has never behaved responsibly, but I guess they were formed right after World War II. But the point is, there was a time when this country had much more of a moral compass and a lot better leadership. I mean, I would take Eisenhower over any president, that we've had probably since him. And so, that all matters. I mean, I can make a strong argument that we no longer have the moral high ground. I mean, when we killed 3 million Vietnamese rice farmers because Henry Kissinger thought it was a good idea, or Nixon thought carpet bombing made sense. I mean, that was just another brick in the wall of the United States is not behaving in a way that's honorable. And I think
I guess it's all a matter of perspective. There's some things that are clearly more black and white than others. But
no doubt, and I'm not suggesting that there's any other country in the world that's more honorable than we are. I'm not suggesting that at all, because I think they all kind of suck. What I hope for and what I believe is happening here is that the internet and Bitcoin and a lot of things related to it are leading to decentralization. and that decentralization is going to ultimately take the power away from the nation states. Because I don't think the average person, unless you're a psychopath, most of the people in the world don't want to go kill other people. And yet nation states manage to create armies and conflicts that get, people who are normal people to go kill other people. And that makes no sense to me. And so I think what we've seen at a 100-year level, I hope my grandkids will live in a world where nation states either are defanged or much smaller or don't exist. So, but that's all kind of utopia, future stuff. I mean, meanwhile, we've got nation states and we got to get through a very messy situation here. I think
right. Meanwhile, we have a scenario where sadly people have been celebrating the loss of civilian lives. Regardless of your political views on the matter, we've had serious, sad, depressing events of people rejoicing in the loss of Israeli civilian casualties. And look, Larry, this is obviously a very complex situation, and some would argue that sometimes it's better that the U.S. imposes sanctions rather than intervene with military might. But certainly weaponizing the dollar in the way that it was following Russia's invasion of Ukraine is causing tremendous concern for the dollar status as the global reserve currency at a time where, you say, we've had unprecedented fiscal and monetary stimulus mismanagement and a very, very likely scenario where there'll just be more money printing, more click money being distributed. So we need to wrap up here. Yeah. A complicated topic with, as I say, various angles and nuances, but give us your final thoughts.
Well, just look, it's, I would say two things. In general, I think that, the best parts of life are family and friends and, keeping yourself healthy. And so I try to focus on that over a lot of the stuff that's bad in the world. And then, I think we all need to have things that we believe in and want to try and make a difference about. In my case, that is sound money. I think that if we had sounder money, some of the problems that exist in the world would not exist, or they would be much less significant than they are today. So what I try to do through my podcasts and other things and my fund is advocate for people holding sounder money. I think if we hold sounder money, it will then force the states to behave in a more responsible fashion, which will then mean states kill less people, which is something I think everyone could agree is a good goal. So, and I think, and it goes beyond that. I think holding sound money also, kind of protects one, and that's a worthwhile goal. I mean, I want to protect my kids. I want to protect the kids that they haven't had yet, someday be my grandkids. And so, to me, those of us who, look around at the world, see all the problems, we can vote with our feet and say, all right, what are we going to do? I'm not president. I can't set the policies, but I can decide what I'm going to advocate for. And I'm going to support people that advocate for and believe in sound money, because I know that unsound money leads to, I think, government mischief that's not healthy for any of us. So that would be kind of my closing remarks. And I think it benefits you if you're in a sound money. If you're in sound money investments, it's rocky. I mean, the last couple of years of my fund, I mean, I haven't had any fun. I mean, I had a couple of really great years in 2019, 2020. And the last 2 years, I've been getting punched in the face. But I know that when you look at Lynn's chart, which will be in your show notes, you can see that there's just no way out of this but more inflation. And so sound money is the thing you can do to protect yourself in that instance.
And for you, sound money is gold and Bitcoin.
Exactly. Those are the two. Silver too. I love silver.
Okay. All right.
It goes with gold, obviously, right? Yeah.
All right, Larry, we're going to have to leave it there. Again, we hope that the situation does not escalate to the nightmare scenarios, but we'll have you back on to see how things develop. Thank you so much for giving us your perspective and analysis on this. Appreciate it.
Thank you for the excellent questions, Michelle. I always enjoy speaking with you. Thanks.
All right. Thank you, Larry. And a big thanks to our sponsor, Swan Bitcoin. And a note for our viewers, the Swan IRA product allows you to invest in Bitcoin with your IRA. You can set it up to buy Bitcoin on autopilot. And there is a link in the description on how you can do that. So check it out. All right, from me, Michelle Makori, and the rest of the Kitco team, thank you for watching. We'll see you again soon.
On the Spot with Michelle Makori is brought to you by Swan Bitcoin. Swan Bitcoin IRA. Your legacy, your way. Real Bitcoin, not proxies. Traditional and Roth IRAs. Fast, easy setup. Start now at swan.com/IRA.